Okay, good afternoon, everybody. Welcome to the hSenid Business Solutions PLC half-year investor forum. And from this year onwards, we have kind of decided that we'll actually do it from quarterly. After the quarter results have been released, we will actually do an investor forum in a similar format. And the main objective of the investor forum is to able to answer questions from the participants, from the analyst community, as well as our shareholders, mainly focused on the results that we had the previous quarter or the previous half year. And the detail of this, I think Nilendra will actually take you through as the CFO on that. And with that, what I would like to do is to actually pass the presentation discussion to Nilendra and Sampath. So again, thank you very much for participating on the hSenid Business Solutions Investor Forum. Over to you, Nilendra.
Thank you, Dinesh. Once again, good afternoon, everyone. We extend a warm welcome to the first half FY2024 Investor Forum hosted by hSenid Business Solutions. We sincerely appreciate your participation and look forward to your continuous engagement in our investor relations program. Before we commence, like Dinesh mentioned, there are a few housekeeping updates regarding our IR program, which I'll highlight to you. Starting third quarter of this financial year, we will transition into hosting quarterly IR calls as opposed to our previous practice of semi-annual investor calls. However, this particular call will cover the entire first half, since we are meeting you after our full year FY23 call that we hosted last. Please take note that during these quarterly calls, as mentioned in our email to all registrations to this call, we will not be delivering a formal presentation. Instead, we will upload the quarterly IR presentation to the IR webpage ahead of the scheduled investor call, like we have done this time around, and notified you via email. We believe this approach provides you with ample time to review the presentation and formulate your own questions to the management, so that we can have a productive IR call. The Investor Day call will be scheduled within 4 to 7 business days following the release of the quarterly results, and the entire IR call will be dedicated to answering and clarifying your questions. With that, I will now move to a quick summary, bird's eye view of the first half results, after which we'll open for Q&A. hSenid Biz recorded a revenue of 758 million Sri Lankan rupees for the half year ended September 30th, 2023. This represents a 7.5% year-on-year growth in LKR terms and a 13% year-on-year growth when measured on USD constant currency basis. As expected, this growth was primarily driven by our PeoplesHR cloud offering, which grew 24.7% year-on-year in LKR terms, and a much higher 35.7% in USD constant currency terms. In first half 24, core recurring revenue amounted to 55% of total revenues, up from 48% during the corresponding period of the previous financial year. It is noteworthy that our margins improved from Q1 to Q2, reflecting stabilizing OPEX and growth in high margin cloud revenue. The core exit ARR, annual recurring revenue, as of September 30th, has now reached 888 million LKR, or in other words, approximately $2.8 million USD, which represents a 28% year-on-year growth, again in LKR terms, and a notable 47% year-on-year growth in USD constant currency terms. Our strategic investments in market development initiatives, including targeted lead generation campaigns, active participation in international events, digital marketing, partner marketing, have yielded successful results for hSenid Biz. And these results are reflected in the successful new deal closures, demonstrating a notable increase in Q2 of FY24, where deal closures were up 141% in USD terms compared to Q1 of FY24. And it's worth highlighting that there is a significant 48% of these new deals were secured from the APAC region. And the growth on the first half total number of new deals stood at 18.5% year-on-year compared to the corresponding period in USD terms. As we look ahead to the remainder of FY24, we are committed to strengthening our market development activities with the aim of securing more high-value deals, particularly in the cloud business. With that, we will now move to Q&A. I encourage all participants to either raise their hand so that we could unmute you and allow you to post your questions, or alternatively use the chat function on the platform so that you can post your messages, which we will then address one by one. The forum is now open and we are happy to take your questions. We have a few questions on the chat, which I will direct now to the relevant panelists. I'll take the first question. Out of the on-premise non-recurring revenue recognized during the year, how much is attributable to the Ugandan project phase 2? How much of the Uganda phase 2 revenue has been left to be recognized in the next 2 quarters? Sampath, do you want to?
Yes, actually we raised one invoice in Q2 with regards to Uganda government project, and we are planning to raise another invoice worth 72 million in Q3, and again another invoice in Q4 as well, size $72,000 in Q4. So that concludes the phase 2 activities. So we are in line with the project plan and delivery plan with regards to Uganda government invoicing as well as revenue recognition. So upon completion of phase 2, there's another phase to come, that is phase 3. The purely a deployment or new unit addition to phase 1 and phase 2. So that will start soon after completion of the phase 2 activities. Hopefully, that means we have another set of revenue planned for next financial year as well. And also, we start the support activities after warranty period for phase 1. That support activities start September 2023, and it's an annual contract starting from September 2023. Upon completion of phase 2, there will be a warranty period again, and then again we are signing a support contract for phase 2 as well, and subsequently phase 3.
Thank you, Sampath. I'll move on to question number 2. Out of the 32 million LKR QOQ increase in cloud subscription revenue, what portion is attributable to the repricing effort? Was on-premise product also subject to repricing program? I'll probably take that question. Essentially, we commenced the repricing program in July and ended it in October. Out of the QOQ increase, I would say there would be negligible revenue affecting the quarter because most of the new invoices happened in October. Hence, it will fall into Q3. And also, from a point of view of forming realistic expectations, you need to understand the full effect of the repricing program will take exactly 12 months from the point of new prices being effective to fully reflect in the revenue and the financial statements of the company. So essentially, we'll be starting recognizing in the month of October, but it'll essentially take 12 full months under the new price regime for that to be reflected in our numbers. As to the on-premise clientele, for an on-premise client that's using our software, essentially what we have is a annual maintenance contract. So we have not subject AMC contracts to repricing. What has been the focus is the cloud business. Essentially, the AMC contract is contractually agreed upon, roughly being 20% of the license value of the initial sale. So to answer the question, no, on-premise product has not gone through repricing. I'll move on to question number 3. Can you explain what has driven FY23 infrastructure cost approximately 90% year on year in USD terms? How does it convert into the improvement in service standards or expansions? what is meant by infrastructure cost optimization. Sampath, do you want to touch on really what led to the infrastructure cost increase, particularly in terms of the higher server and infrastructure quality we provided to our customers?
Of course, we enhanced the infrastructure standard because we are now ISO 27001 certified company with the cloud security certification. So we are very much concerned about the security aspect as well. So we enhance the cloud infrastructure. So we had to incur additional cost there to lift the standards. And same time, we are working on a cloud optimization exercise at the moment, standardize overall cloud infrastructure. So that project is going on, hopefully that will lead to next quarter as well. So with that, actually, we are planning to bring down the costs a little bit, or rather same level by increasing number of employees onto the same cloud environment. So incremental costs, we can manage very well with that.
Moving on to the next question, what has driven the encouraging new deal closures? Is it specifically attributable to market development activities that took place during the quarter?
Yeah, I think mostly, yes, as Nilendra very correctly mentioned, Q2 sales, if you really look at majority from the APAC region. So we are doing major campaign, in the region, APAC region, to improve our sales and marketing and our visibility in the region. And also, resource utilization point of view. Now our top team utilize in the region, so they are into lead generation. And we heavily use, digital marketing activities as well for lead generation and event participation. So with that, actually, our pipeline has grown drastically compared to last year, Q4 and Q1 this year. And so, we have a steady funnel and then closure pipeline at the moment. Yes, so that is directly attributable to market development activities we are carrying out.
Next question is the reason for cost of sales to increase year on year. Maybe I can take that. So if you really look at Q2 versus Q1, definitely we have not just stabilized, but improved margins. However, if you look at first half as a total compared to corresponding period of last year, there are multiple reasons, behind the cost of sales increase. One of which I think Sampath explained, which is the infrastructure cost increase. And second, of course, is the higher cost of people that we had to incur. First, from a retention point of view, the volatilities that the IT industry as a whole has been facing, particularly with migration, with remote work opportunities from overseas software companies. So this has led to a significant increase in the cost of talent. And in certain cases, we had to proactively increase our cost base in order to retain the talent. And also, secondly, wherever there was staff turnover, replacements have come at a much higher cost than previously expected by and enjoyed by the company. So this has definitely given rise to first half of FY24 versus corresponding period of previous financial year cost increases. Nevertheless, we need to mention that Q2, we've seen an improvement from Q1, where the margins have not just stabilized, but also improved. Moving on to the next question, why only focus on HR systems? Any idea to look at different areas to reduce the dependency on one or few products? Dinesh or Sampath, do you want to take this?
Yeah, if you really look at HR domain, the market sizing is around $10 billion only in APAC region, so there's a big opportunity in that area. So when you focus on one product line, even though we call it HR, if you look at the product, there are core 9 areas and overall 27 modules and more than 50% component. So it is like a ERP, mini ERP solution for organization. So we are working on that scope, because when you focus on one domain, and you can be the leader in certain areas. So that's the focus at the moment. Like, we will not move into non-HR activities, but of course, let HR line. We are expanding our services. Now, simple example, HR or human resource outsourcing services, human tracking solutions. So those similar lines will expand our business, like, going forward as well. And even the people's HR marketplace will bring, like, certain solutions to our customers. And we will work on those areas, but we don't have an immediate plan to move out of HR domain and focus any other area, because scope in this area itself is huge. And there's a very big potential globally.
Thanks, Sampath. And if I just add something to it and just stress on an important word that Sampath mentioned, I think it's all about focus. So focus in terms of domain, which is the HR related systems that we do. And then also on top of that, I would say focus in terms of markets. We want to be really focused in terms of the markets we go into, so that we really go deep and establish meaningful market share and presence in those markets. So I think that I would say that summarizes our approach. Next question, also probably to you,
I'll
Sampath.
take the next section. Like, so yes, we start the
Sampath, for the benefit of everyone, I'll read out the question, because I think our participants may not be seeing the questions. So the question is, do you have any AI related HR products at the moment? Over to you, Sampath.
Yeah. So yes, we start the AI journey maybe 18 months back. So we set up a innovation team within the organization to work on some of the latest technology, not only AI, IoT, intelligent automation, and most of these areas. So at the moment, there are certain AI related products are already released, especially when it comes to a recruitment module. We are heavily using AI on that, especially sentimental analysis, behavioral assessment, then shortlisting, long listing, these areas, we are using AI at the moment. At the same time, certain other areas like analytics. So you can do predictive analytics today, so we use certain data, and also to understand employee happiness and engagement levels within the organizations, we use AI. Same time, especially when it comes to payroll and stuff like that, we use anomaly detection and various different areas, just to minimize the cost and understand problems well in advance, so user can correct themselves without even reaching us. So there are multiple activities happening even at the moment. So product will be enhanced based on those capabilities.
Thank you, Sampath. When are you planning to start phase 3 of Uganda project? I think we addressed that. It will be beginning of next financial year, with phase 2 coming to an end in this financial year. Given that HBS has utilized 100% of the IPO proceeds that are allocated to market development, what is the outlook for that front? Sampath, you want to take it?
Yeah, so we have not utilized fully, if we look at, because IPO funds we have planned for 3 different areas. One is market development, one is product development, and third component is potential acquisition. So we have not touched the acquisition value. So we will keep you all posted our plans on that soon. And on the other 2 fronts, actually market development activities are happening. So we have utilized the major portion of that fund, and the product development activities as well. Now, product development activities will continue, of course, research area and stuff like that. So we have internally generated funds to continue our product development journey. And market development activities still it is not fully utilized IPO funds, but we are well placed to continue our development work next, I would say 24 months and beyond.
There's a question on what would be EBITDA and NP margins after the repricing exercise. I'll take that. So I'm not going to comment on NP margins, because there's a lot of volatility that happens at NP level, and comparisons become difficult with taxation, with FX gains and all that. But I would say from an investor point of view, it is more accurate to look at EBITDA margins, which is more relatable and also controllable from our side from a management point of view. So Q1, normalized EBITDA margin, and when I say normalized, referring to normalizing for FX gains, interest income, all non basically non-core revenue items. So if you look at normalized EBITDA margins, Q1 was at negative 19%, obviously given all the cost increases that they've been taking. Q2 was negative 13%. Of course, our immediate target is to ensure that normalized EBITDA margins break even. And then, of course, become profitable as well. As a rule of thumb, something that we benchmark ourselves is that there is this rule of 40 that applies, or that is usually used in the SaaS industry. Rule of 40 essentially means that the best performing SaaS companies, EBITDA margin plus revenue growth rate on a year-on-year basis should be equal to or exceed 40. So our aspirations as a company essentially is to make sure our normalized EBITDA margins get to about 15%, with revenue at about 25%, and the addition of those two will give us the 40% rule of 40, basically to be equal to that 40 number, which is the benchmark for a good, well-performing SaaS company. So our plans are to get there as soon as possible. Next question, what has driven... maybe before the next question, I see one person has raised their hand, so we'll probably take that question and then move on to the written Q&A. Ranjan, over to you.
You have to
Ranjan,
unmute.
you're on mute.
Do we have to unmute?
I have clicked on ask to unmute.
Thank you, Nilendra.
Okay.
Just a small question following up Mr. Watpil Sampath regarding acquisitions. So there's a certain amount of money that is left over for acquisitions from the IPO proceeds. Are there any potential targets that you all have looked at for maybe acquisition in the next 12 months? Are there any something in the pipeline that is being discussed so far?
So, Ranjan, I mean, we have been continuously scouting the market for acquisition opportunities. It's just that we don't want to jump or rush at every opportunity that comes our way, because we are always weighing organic growth, which is fueled by sales and marketing spend, versus inorganic growth, which is going to be fueled by an acquisition. So right now, given the valuation expectations of some of these companies we've been looking at, given their growth profiles, up to now, based on the opportunities we've seen, we have seen the kind of pendulum swing in the favor of organic growth, where we've been pouring in a lot of market development expenses, as we highlighted in some of the answers before, and also sales recruitments in these key markets that we are focusing on, because we have felt that the risk reward or the payoff for organic growth has been good enough. Nevertheless, if some opportunity comes by, which is interesting, which really has a reasonable payoff compared to the results we are seeing on the organic growth, which is fueled by selling and marketing expense, which is our investment, our customer acquisition cost, we will definitely explore that. But as of now, we continue to explore opportunities and haven't found one that basically hits the sweet spot.
Thank you, Nilendra. Just a small follow-up on that. So earlier, Ms. Sampath mentioned about plans regarding to focus on the core activities of the HR, in the field of HR. In an event where something sort of an interesting proposal comes your way, like maybe on some other field to divest from the core competence, is there something you all are looking at, or can we expect acquisitions coming in the same lines of business lines of HR?
We
Yes,
will consider
Sampath.
Ranjan same line of business primarily. Like, we will not change the domain because we have a lot of expertise in this domain now developed over a period of time, more than 25 years. So we look at a similar line of business.
All right, thank you. Got it. Thanks again.
Thank you, Ranjan. Let me move on with the Q&A on the chat. What has driven the quarter-over-quarter increase in admin expenses and selling expenses by approximately 20 million LKR and 30 million LKR respectively. So essentially, what you're seeing in Q2, I think we mentioned this when in our previous investor call as well. Most of the senior hires that we made, the first full quarter where you see all of these costs essentially is Q2. So that's why you're seeing the full burden costs of all the talent acquisitions that we did getting reflected in this P&L. As we mentioned in our previous call, we don't see any more significant increases in headcount, particularly senior talent, with the exception of sales staff that we may recruit, in particular markets so that we have better focus. But from a senior talent point of view, I think what you see is pretty much our full burden cost during the last quarter. Moving on to the next question, your other income for the quarter has increased by 1,125%. What is the reason behind this? This is predominantly FX gains. So if you look at quarter one, we had FX losses because of the rupee essentially strengthening against the dollar. And quarter two, we had that reversed where the rupee depreciated, leading to FX gains. Do you have any other future plans to partner up with SL government to restructure SOEs? I don't think the question is relevant to us. No.
No.
No, not at all. There's another question. Can we expect plans to expand through acquisitions in the coming months? I think it's from Ranjan. I think we answered your question. Do you prefer larger clients or much smaller clients? In terms of margins, please explain. Sampath.
Yeah. So larger clients comes under two categories. We prefer larger SaaS customers, cloud customers, so margins are much better, when you work on a large accounts and especially on the SaaS side. But still, we are getting some accounts from, especially MEA region, African region, large accounts, but on on-premise. So the advantage is then you get a larger license component during first one, but then ongoing basis only a maintenance revenue, we are earning year on year. Yes, we much prefer to get large accounts. Obviously, margins are better, especially in the APAC region.
So as of now, I think we've answered all the questions that came on the chat. So I'd like to invite again those of you who are joining us on this call, if you have any questions and prefer to post those questions, please raise your hand and we will allow you to unmute yourself and speak. I think there's two more questions on the chat. Are market development efforts considered as capital nature spending? So from an accounting point of view, I think we have been mentioning this consistently, and thank you for raising that question. As a software company, all our CapEx are in fact OpEx. So the CapEx-like items we do are these market development efforts. This can be PR, this can be digital marketing, it can be events that we hold to invite customers, potential leads, make our brand and presence felt in a particular market. So all this, what we call customer acquisition costs, are expensed right through the P&L. Nothing of that, those costs are capitalized. So yes, all investments we make, which are capital in nature, when you compare the software business, are hitting the P&L and getting expensed in the P&L. So essentially, we are making losses in day one for all the market development activities we do, the recruitments we do to accelerate our sales. All of the costs are hitting the P&L on day one, but the revenues will come with a lag. And the lag is because of two reasons. One, a sale itself, a deal closure itself will have typically a 3 to 4 month sales cycle from initial proposal right up to final agreement sign off. And then from that point, again, probably another 4 to 6 months of implementation time, before which a client essentially goes live. We call it the go live event. And we start billing, if it's a cloud client, we start billing subscription revenue. But when we keep doing this over and over again, you really see that hockey stick effect of subscription revenues accumulating. And in fact, what you're seeing basically with the higher sales numbers that we've generated in Q2 is it'll take a couple of quarters for these to start getting reflected in the earnings. And that's when you'll really see a big takeoff, exponential growth in our numbers. So thank you for raising that question. People's HR business accounts for about 50% of the revenue. Is this going to increase? Sampath, do you want to take that?
Yeah, I think as Nilendra mentioned at the very beginning, our core area is People's HR. People's HR business is the growing business, especially a cloud business. So the advantage is actually when you get sales, cloud sales, and there's a annual recurring component adding to the P&L, so that's the value we are creating. So this will continue to grow in overall business.
The next question, given the development of AI and other free tools in HR, how is the future? And if it is a risk, how is it planned to be mitigated? Sampath, you want to take it?
Yeah, so I'll start and then you can add anything. Yes, of course, in technology area, always we are working with risk and return, so we are also well placed. There are many projects happening, within the organization, as I told you earlier, AI area, intelligent automation area, low code, no code area to bring down the development cost structures and stuff like that. So, we also use latest technology for our development work. So that's what we have to always look at, how to get the maximum out of available technology. So we also continue in that journey. So we will keep on improving by utilizing latest technology. So, because of that, we won't see a threat or risk in immediate future. Of course, the technology area, very difficult to predict what is going to happen in the future. But of course, developing enterprise level application is not that easy. So it is with a lot of effort, and you have to mature the solution as well for enterprise to use application. So that journey is not that easy. Developing a small mobile app or whatever, that is easy. But enterprise application journey is different.
So I'd like to just pick on one word that Sampath said, enterprise. There is a big difference between B2B and B2C software. B2C software is particularly an area where, as long as you give the sleekest, smoothest new UI, you'll have consumers switching and churning from whoever the incumbent vendor en masse. You will see that churn happen and a new player winning. B2B is an area where, and particularly enterprise, is an area where it's a segment where there is a lot of complexity that we are getting involved with. And if you really look at the product, one of our key competencies, apart from the multiple countries that we have localized the software and are statutory compliant for, one of the key competencies lies in the fact that there is more than 25 years of domain experience built into this product. Now, what that means is, say, a new startup or a new company that comes up with a, let's say, hypothetically, a free HR tool will never be able to within a short span of time, build capabilities to handle that entire complexity that is inherent in an enterprise that typically that we cater to. And it takes time, and that time that we've spent in the domain and the complexities that we've gone through operating in 20 plus industries, from banking to retail to manufacturing to hospitality, healthcare, services, so on and so forth, puts us at an advantage where the barriers to entry is much higher compared to B2C. And then secondly, compared to even B2B on the SME businesses, where our needs can be much more simple. So given that we operate in the higher end of the middle market and enterprise, that puts us as at an advantage. Moving on to the next question, with many large organizations developing their own solutions, how would that affect HBS? Sampath?
So, like again, like it is same line of business, like because the enterprise application, it is not that easy to develop and deploy within an organization. We have seen this happening in multiple countries. Time to time, large organizations decide to develop HR solutions or finance solution in-house, but after a year or two, like that project failed and coming back to a vendor, external vendor, like because vendor point of view, your focus is developing HR solutions. So you look at, like, benchmark your products with global leaders in that particular domain. You develop domain knowledge within the organization. There's a very much focus, and it's a huge effort. Like company to develop an internal HR application and run within the organization is not practical, and it's not advisable as well. Like so companies won't do that. Actually, even large corporates, that they will not go that path. Like because end of the day, it is not just the code. The security, the infrastructure, like the things you have to manage is not worth, like because you have to focus on your business and allowing other third-party companies to focus on their domains and their expertise. So because of that, I don't see any threat in this area. Of course, like time to time, people are trying, and but we have come across many scenarios where after a year or two, they're coming back to the solution, and that's a common trend.
And if I may also add to what Sampath said, I think success in this domain, probably like many other domains, requires not just a good product, but also good implementation services. I mean, you can have the best of product, but if you're unable to implement it properly in a way that the client and their users embrace this product, embrace the new digitalized journeys that they have to follow for all their day-to-day activities, we've seen so many projects end up in failure. So yes, you need a good product. And secondly, you need a lot of experience and expertise in order to ensure that your client successfully goes through that digital transformation journey and starts using that software. Because if you don't have customers using your software, I mean, all your customer acquisition efforts probably can go into a waste if the client churns in 1 year. So I think that high stickiness is really coming through successful digital transformations, and us as a vendor, not just selling software, but providing the services that are required to make the customer benefit from that software. So I think that is an integral part of our offering. That's it for the questions. Again, up to now, we've taken all questions that have been raised. If there are any questions.
There's another one, Nilendra.
Yeah, yes. Do you have any subscription-based products and thoughts on the potential for subscription-based solutions, Sampath?
Of course, like our People's HR platform, is a subscription-based product. So customers are paying per employee per month rate or per employee per annum rate. So it's a complete subscription-based business. And as Nilendra mentioned at the very beginning, majority of new business are on subscription-based. So that's the good news. So subscription revenue will grow in next few quarters as well.
Yeah. So I think just for everyone's benefit, when we highlight this key metric ARR, essentially we are looking at recurring revenue, and essentially that's subscription-based revenue. Because the beauty of ARR is the non-linearity. So every quarter, the customers we acquire The customers we then take through successful implementation, go live, and coming to the subscription bucket essentially keeps adding. So the more you keep doing this, essentially you'll see an exponential growth in the ARR number. I mean, even those numbers are visible right now with, I think we mentioned the growth rates, ARR growing almost 18% for Q2 on USD constant currency terms, slightly over 30% year on year. So these growth numbers are possible because of that non-linearity in subscription revenue, where every subscription you keep adding accumulates, provided you manage your churn well. I think on the presentation we have presented our GRR and NRR numbers, that is gross retention ratio and net retention ratio. And both numbers are up from what we presented to you last during our last call. Our gross retention ratio has gone up to 99%, and net retention ratio has gone up to 102%. What this means is gross retention ratio is essentially 1 minus churn. So we've lost only 1% of our customer base, 99% has retained. Net retention ratio basically is adjusting for churn and headcount expansion and module upsells. So essentially the revenue base we started with at the beginning of the period without new customer additions, ignoring new customer additions, have grown to 102%. What this means is that our existing customer base is also starting to spend more with us in terms of software consumption, and you layer the new customer acquisitions on top of that, that's when you get exponential growth. And we are happy to note that our NRR, which was 97% last call, that was full year FY23, has gone up to 102% as we have reported in our earnings presentation. Yeah. Given the talent costs are high in Sri Lanka, any plans to move to other areas with cheap talent?
Actually, if you compare last year, 2022 to 2023, yes, there's a drastic improvement of talent cost. But now I think things are stabilizing. Even the attrition rates have gone down, like, in the industry level. So we are not, I don't think like it will drastically improve, like, cost structure during next couple of years as well. On the other hand, as a risk minimization strategy, now we have a second development center based out of Dhaka, Bangladesh. So that is the first outside Colombo, like, development center for hSenid Business Solution PLC, like, so we are looking at multiple options, like, but overall now cost has stabilized.
Yeah. Question.
Okay, so once again, thank you everyone. And in conclusion, let me remind you that we will be uploading this call on our investor relations website for the benefit of those of you who couldn't join us today. And we look forward to engaging with you on a quarterly basis on the same format. And we encourage continuous engagement so that we keep you abreast of the progress we are making as we move towards targets of being the most preferred HR tech vendor in the emerging markets. Thank you very much, ladies and gentlemen. Wish you a pleasant evening and a good weekend. Thank you.
Thank you.
Yeah, thank you, everybody.